David, good morning. I love how you go out to 2022 and you get us out, I think it's SPX 4600. How do we get there?
Well, you get there a couple of ways. You get there to around 3,700 at the end of this year. You get there to 4,300 at the end of 2021, and then you get to 4,600 at the end of 2022. So that's the path, and sort of what are the building blocks behind it? Well, basically, you've got an economy that's getting better. You have earnings that are growing, and you have the rates that are staying super low. I mean, those are the three building blocks. It's not so brilliant, and it's also the TINA trade. What is the alternative? What else is there that's out there? And equities becomes the default opportunity. So I want to think about the following way, Tom. Break the market into two pieces. Let's take the 5 big stocks that are almost a quarter of the market, and let's take the other 75% of the market. Those big 5 stocks, their sales were up 18% this year. Sales for everything else, down 5%. So that explains why these stocks were up around 50% year to date. So they had a great year. We understand that. We're looking forward. What's the path forward? These companies are expected to have revenue growth each of the next couple of years of around 15%. So that's kind of part of your leg going forward, Tom. And the second part, if you think of the other 495 stocks, they're expected to have around 6% revenue growth, top line sales growth of each of the next couple of years. So that's basically the story. It's about an economy that's getting better, coming off the pandemic crisis low, and generally getting better. The Fed on hold. That is our general assumptions. The vaccination of half herd immunity by May of next year. All that is to the positive, and I think the market is recognizing that, and will continue to do so.
David,
as it rolls
when you say TINA, it just sounds like a multiple story. But when I talk to you and when I read your research, it's not just about the multiple story. It's about better earnings that you're looking for, and above consensus earnings too. David, can you walk me through why you're a little bit more constructive than maybe the consensus is at the moment, on earnings specifically?
So if we look at the earnings, Jonathan, it's a good question. So the consensus expectation is around $165 of S&P 500 earnings next year, 165, and we're at $175. What explains that? Well, part of it is a better economic backdrop. We've got GDP growth, something around 5%. The consensus expectations of 49 economists in the blue chip forecast around 3.8%. So that's a higher level of activity. There's not much inflation out there, inflation under control. So that's basically allowing companies to have that broader level of earnings growth with not a lot of pressure on input costs. So that's your margins are basically part of that is recovering. And so those are your two building blocks as we see it in our models. And the Fed has made it very clear, in our view, that they're on hold for the next 3 years at least, perhaps as long as 5 years, based on the economics forecast. And so that's a pretty benign backdrop. It's a good backdrop for the equity market. And when you think about the asset allocators, the portfolio managers out there, around 50% of the assets are allocated to equities, about little less than 25% to bonds. So what's the alternative? Cash is offering 0. And so it's still an attractive place for the equity market, Jonathan.